You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
It is that time, folks. It's time to talk about money. It's time to hit my headphones on the microphone. You know, every time I do that, if I'm a little close, I smack right into the microphone. Hey, everybody, I'm Don. That's Tom. We're here to talk about investing, saving, spending money, dealing with it. And it's really easy to get your questions answered. You just call us at 855-935-TALK, 855-935-8255. And even though we're doing this show live on Easter weekend, we're here for you. We don't take it off.
Yeah, we are. I'm not at all.
Though,
I mean, yeah.
Florida's nuts right now. Florida is nuts.
Oh, everybody's there.
It's full of people. I went to Chick-fil-A today.
3-hour wait? 2-hour wait?
No, I don't go to the drive-thru. I put in my order. And I have them bring it out. Until I'm immune, I'm not going back in. Until I've had my second shot in 2 weeks, I'm not. I'm just not. I've made it this far. I am not taking any chances. I pulled up today, and there was not a parking space available.
Whoa.
They were directing traffic into multiple drive-through lanes where they had employees out. Everything was blocked up. It was packed to the gills. There was heavy traffic on all the roads. They're packed. What are you people doing?
Can I make a suggestion? You can make, and I think I have this right, you could probably make a chicken sandwich at home. Probably.
Yeah, but I don't have the ability to pressure I don't have my pressure cooker. That's not here.
Oh.
You know, you got to high pressure fry that stuff for it to really be.
That's true.
You know?
That's true.
Plus, it's the secret sauce, the recipe.
Well, that's just a little pickle juice and sugar, my friend.
Plus, let me tell you the other thing. I don't have to clean up the kitchen when I go to Chick-fil-A.
Well, there is that. It's delicious. It's quick. Yeah.
Sure. And the price? Yeah. Come on. $7 for a Nuggets meal? I can't do that. It would take me 20. Hello?
When you say it that way, it sounds like you're 12 years old.
No, I'm 60 some odd years old, and I
know,
don't want to do it.
When you say the Nuggets meal, it makes me think of my kids.
Not the kids meal. I didn't say the kids meal.
Right.
My wife.
That's how it sounded.
My wife gets the kids meal. She's that frugal. Right. She looks at the prices. She goes, "I'm not paying $7 for nuggets. I'm getting the kids meal, and I get an ice cream." So anyway, hi, welcome to the program. I'm Don, that's Tom. I think I said that. 855-935-TALK is our number, and we're here to talk about how you can live your life better through the miracle of modern money science. And
most people, there is a science. Most people also get a lot of bad messages about this. They're out there regularly. First quarter, great indication about sort of getting rich quick, right? Whether it was NFTs, whether it was lean hogs, or GameStop or AMC. There are a lot of messages about their Bitcoin. The message is you're not doing well enough. You're not doing well enough quickly enough.
Well, yeah, everybody knows that the competition to become the next Jeff Bezos or Bill Gates or Elon Musk is still open. We could win.
You have to work really hard to do
and you notice that none of them made their fortune betting, gambling, playing the market.
I think they started companies, and the company worked out pretty well. They went to the public markets.
It's funny,
they got a lot of money.
Even the hedge fund managers, the big hedge fund managers, didn't make their money gambling on their big hedge fund. They made it getting you guys to gamble on their hedge funds, and they just take big fat fees.
Don't get me going. But, our friends at the Motley Fool have rescued us with a nice piece about all this, and they're suggesting a few things when it comes to keeping it simple, keeping it long-term. One of them is don't trade as much, which people have sort of got caught up in trading.
Wait, I have a better idea.
Yeah.
Don't trade at all. There we go.
Oh, there's that. They also mentioned, I think, you don't sweat PE ratios. They're not talking about the physical education ratio either here.
Price earnings.
Okay.
Wait, I have
I don't think you should.
Wait. I have a better suggestion.
You in the back?
Ignore the PE ratios. Who cares?
Completely.
Yeah.
Yeah.
All right. Am I doing better
You're
than
2
them?
for 2. You're doing 2 for 2 so far. You might. We'll see how you do on the egg roll later. Think of your portfolio as a whole, which is something most people do not do, but definitely should.
Yeah, but I read their article. They weren't really talking about portfolios the way we are. They're talking about portfolios of individual stocks like NVIDIA or Intel.
And which makes me laugh when they say don't bother trying to time the market, and then at the bottom of the article they sort of blow all their advice away when they say the 10 stocks that could be the biggest winners of the stock market crash. Now, if you're telling people that a stock market crash is coming, what are you telling them to do?
Time the market.
Get out
I
of
get
the
that
market.
one right?
I mean, absolutely. You're
I'm doing
like
really well.
3 for 3 or something. I mean, why in the world would you write this pretty good article that tells you, don't be so quick?
Excuse me. It was a pretty good headline. It was
The headline was phenomenal. That's true. The article, because PE ratios, nothing to consider.
Oh, and then can I read this final line? Oh, please let me read this final line. When investing geniuses David and Tom Gardner have an investing tip, it can pay to listen. After all, the newsletter they've run for a decade has quadrupled the market. How come their mutual fund hasn't even matched the market? You mean they got a newsletter that does better than their mutual fund? I wonder why that is. 855-935-TALK.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
For your real life and real future, Tom and Don are talking real money.
We are trying to help you find the right path to the best possible future in the shortest period of time, at the lowest fees, with the fewest problems, and the least confusion. That is a lot of stuff we're trying to help people with.
While not getting emotionally caught up in your decisions.
Well, that was good, too. I like that.
Thank you.
Thanks for throwing that in. 855-935-TALK. I'm Don McDonald. That's Tom Cock. And Bob, welcome to the show.
Hi, Bob.
Hi there, Don. How you doing?
Good. What's up, sir?
I want you to take a look at my mishmash.
Oh, your hodgepodge, huh?
I got it all in E-Trade. And in that E-Trade, I got 7 Vanguards, 2 straight stocks, and 2 annuities.
Okay.
What do you think?
One. Let me start with
the
this
amounts?
one. Yeah, in a minute, maybe. First, I want to start with, why do you have the 2 stocks?
I was just playing around one day to figure I'd see how it works with how fast it builds up or goes in the toilet. And I still have them.
Yeah, I mean, I could leave the stocks because I know that they're very volatile and it's impossible to know when they're going to have good times or bad times. And, it's more like, as you almost said, it's almost like gambling.
Well, and we can go back and look at periods of time where Bob, you would have owned certain stocks and not made money in a time of great market run-up. The S&P 500, for example, in the 90s, making over 14% a year, and 1/4 of the stocks in the index lost money in that period of time. So that's why we don't make bets on individual stocks. Yeah. I don't know that. I mean, that we can go through all the funds you own.
Yeah.
One is Caterpillar and 2 is Verizon.
Yeah. Again, I wouldn't own individual stocks. I can't tell you what I can't tell you what anything's going to do in the future at all, Bob. Can't tell you. If you have a variety of funds, though, and they're small cap, value, international, large cap, you've got a mix with the Vanguard thing, then, that's fine. But the thing that sticks out to me is the stock component. I just don't see the reason to have those. The annuities, they may make sense, but again, in the confines of this show, to go through the whole portfolio with you and try to rebuild it, that's one of the reasons why we invite people to sit down with one of our advisors and kind of go through this stuff, because it could take more than the whole hour, literally, to go through it properly.
we actually take those and put them into the software and tell you how diversified you are, how much risk you're taking, and how much you're paying others. If your money's at Vanguard, you're probably not paying others very much. That part's good.
That's good. Yes, we like that.
But most people are not as diversified as they should be generally.
Yeah, we find that people have, for example, in their mutual fund portfolios, they have a lot of duplication. They may have a growth fund and an S&P 500 fund, large cap growth fund and an S&P 500 fund, which means they basically have the same fund twice. They'll have active management mixed with index funds, or they'll have all active funds. And at Vanguard, even, you could have all active funds. So, Bob, the de-hodgepodgery could take some real serious time.
And you can go to Vestory.com and contact us, and we'll be glad to look at that portfolio. We give you the free hour to sort of give you a shot at where you are.
No sales pitch.
No,
period.
No obligation. Yep.
855-935-TALK. That's our number. And Glenn is up next. Hi, Glenn. Welcome to Talking Real Money.
Yes. I'm a school teacher in Washington State, and I'm with the Department of – I have my retirement in the Washington State Retirement Program. And my school district offered an advisor that would sit down and talk to us, I thought in general terms, like saying, hey, I'll tell you about how long you have to go until you retire. So in good faith, I got on the phone with this folks, and basically what they did was they tried to talk me into, my wife and I are both teachers, into once we retire, even before, into an annuity, not just a little bit. Cash the whole thing out, put it all into an annuity. And
wait, your school district recommended that?
Oh, this happens, sure.
As far as I understand, this person I talked to was sort of the go-between between all these insurance companies, and these are vendors, and so they've been supposedly, quote-unquote, approved by our district and by the state of Washington to do this. Yeah. But I had no idea that I was walking into a bear trap when I started talking to these folks. And they basically gave me no option except annuities. In fact, they spent a vast amount of time basically saying that the Department of Retirement is a gamble. It's in the stock market. You're not going to be, you're taking a gamble. You're too risky. Get out of it. Put all your money into annuities. And anyway.
This is unconscionable. I just want to come right out and say to your school district that this is unconscionable. Every single school board member and school executive should be ashamed of themselves. And the likelihood is, and I don't know this for a fact, which means I have to say likelihood, is that somebody's getting something in return for this recommendation. There is some sort of a kickback, whether it's golf outings or dinners or a little cash under the table. I don't know, but I'm telling you, there's something untoward here. Your school district their advice is reprehensible. It is horrible. No insurance product should ever be sold to a teacher. And yet it is the norm among school districts. And by the way, it's the norm according to your union because they get kickbacks for selling.
We've seen that.
The National Education Association has relationships with insurance companies through which they actually get money for selling this garbage to these teachers. I am horribly appalled. I would keep doing what you're doing and ignore this idiot.
Yeah. So, I mean, here's what I would do because you're right. There's no reason ever to roll, by the way, a retirement savings into a qualified amount into an annuity. That everybody should walk away from that. Number two, if depending on which program you're in, PERS 2 or 3, whatever, there's some things to know about all that very importantly. And you can get that advice independently without paying anything. There's all kinds of advisors who are not selling annuities who will take an hour to an hour and a half to look at your situation.
There are even, you could go to a Vanguard, you could go to a Fidelity. You're going to get much better advice from any of these people than from some insurance agent who is trying to generate let me tell you, it is a huge, huge commission that insurance person would have received if they had gotten you to do this. Thank you for being so much smarter than your school district.
Your instincts are correct here. And again, We hear about this regularly. It's hard to believe it still exists, these relationships where people can walk in the door and be the trusted advisor and make a lot of money selling a lousy product.
There is somebody in management, the superintendent, assistant superintendent, school board members who listen to this show. Do you folks realize what a horrible disservice you're doing to your teachers?
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, VESTORY.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Now that he's calmed down again, ladies and gentlemen, he took a pill for this. He's taken a deep swallow. He'll be taken back to his ward after the show and reshackled to the wall.
Thank goodness my studio is padded. That's all I can say. See, they got padding. There's padding right there.
You do have padding, yeah.
Because this truly infuriates me. I'm not putting on. This is one of the things that angers me the most. And by the way, hospitals, you're not out of the woods either. You're also a bunch of idiots for allowing the annuity guys to come and sit in the cafeteria and sell your employees some really horrible annuity products. No annuity product belongs in a qualified retirement plan, period. Exclamation point. Yeah. Ever. Because it's more expensive than a comparable mutual fund product would be. And it doesn't add any tax deferral.
You already have the tax deferral. I mean, basically what you're doing is you're giving them the money. They invested in stocks and bonds.
In the case of fixed annuities, yeah.
Right. And then they just pay you less.
And then, of course, some of them sell variable annuities where they put your money in a mutual fund and just charge you 3 times the fees.
Because you just make too much money as an educator. That must be it.
It's always look out for your insurance agent month, isn't it? 855-935-TALK is our number. Hey, Greg, welcome to the show.
Yes, thank you.
Hi, Greg, what's up?
Happy Easter, gentlemen.
Thank you.
I'll give you a little background first. I'm a 71-year-old dedicated retiree, retired military. So retired military and Social Security are our mainstay, but it's adequate to cover all of our cost of living, including the mortgage. Although if I predecease my wife, survivor benefit goes down to 55% of that military pension. The only indebtedness that we have right now is mortgage and a loan against a life insurance policy. I think we're in pretty decent shape with a 401k rollover I have, and then some assorted IRAs, traditional and Roth, for my wife and I. And I consider myself to be, even though I haven't taken your profile test, I consider myself to be kind of moderate aggressive to aggressive tolerance level.
Okay.
Therefore, I'm probably at about a little less than 15%, little less than 15% in bonds, and I maybe carry about a 5% cash. And last year, about this time, I know I shouldn't be gambling. I learned that lesson a long time ago. But I also kind of follow the adage of if you only gamble on a sure thing. And I looked at Berkshire Hathaway when they dropped like 20%. That's kind of a sure
in March.
Thing.
Yeah.
Yes.
Yeah. I wouldn't even call Berkshire a sure thing, but it's more like a mutual fund than it is an individual stock. So that's better because it is more like a mutual fund. So what's your question?
That's kind of my thought, too. Well, first off, I did put about, maybe 20% of my rollover into Berkshire at that time. So I think right now, I'm just kind of looking for positive reinforcement on that I should take my 40% plus return on that and transfer it then into something more like a Vanguard 500 index.
Well, we're always going to say that. And by the way, even Warren Buffett is going to admit that if you corner him, because he's admitted that the future will not be as bright for Berkshire as the past has been, due to a number of factors, one of which, of course, is that he's getting kind of old. He won't be running this that much longer. Number two is he admits there's an element of luck to the way they picked the right stocks and ran the right companies and created profits that were larger than other companies. So it worked out very well for Berkshire Hathaway. And I think if you just bought the Vanguard Large Value Fund over the last 15 years, you made more than being in Berkshire Hathaway anyway. At probably less risk because you own a lot more securities than he does. So yeah, I would take my winnings. I would, if value is what you want to invest in, make up that part of your portfolio. I'd own the Vanguard Value Fund. It's large U.S. firms.
Yeah, they have a value index fund. They have a small cap value index if you're a little more aggressive, which for a small portion of the portfolio might make sense. And for the base of the whole thing, look at the Vanguard Total Stock Index or the VT, the ETF version.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
All right, I'll admit it. I will come out and admit it. I truly expected that, given the fact that we were recording this the day before Easter, that we're doing the show live the day before Easter.
This is live right now. Okay, people are going to think this is recorded.
Well, this is for the podcasters.
Got it. Okay.
For the real audience, we're live. If it's Saturday at about 3:30 Eastern time.
Yeah.
Anyway, I was going to admit something. I thought no one would call.
Yeah, you thought they'd be busy at the egg roll or maybe their way to the tulips or something like that, but boy, were you wrong again.
Are you just craving Chinese food? I keep hearing you mention egg rolls.
I think that should be on the... No, I'm talking about the egg roll down the hill. Come on, the egg roll. Oh. Anyway, it's Easter tomorrow.
We have no hills in Florida, so...
That's true.
Nothing rolls.
No egg roll. That's a good point.
855-935-TALK is the number to which you
Other
have
than
been
your career
calling.
Goes down
yeah,
that hill.
well,
So sorry.
It is time. I'm in my 60s now. I've passed my peak. Alan, you're up. Welcome to Talking Real Money.
Bring us back.
Just a minute. I have to tell the people, leave that egg. Leave that egg alone there. Just a second.
Put that egg down.
I'm ready.
There he goes. Thank you, Alan. I appreciate it.
Take your hands off the egg.
Especially the chocolate ones. The other ones, a hard-boiled egg, I don't care. But chocolate egg, yeah, all over that. How can we help you, sir?
Long-time listener, and so thank you for all of your guidance and your show. What I have is a situation, and I need you to. I've only taken the first step, and so I'm holding off on anything further. I found out that my 87-year-old mother, her money was being invested under advice from a financial institution, which I would give you the name of because I'm so angry with them. Completely risky stock at 87 years old. And so what I did was I was able to move that money over. And the first thing I did was I thought safety. So all I did was I put that money into CDs. Purely safety.
Step back a minute. What was the stock they put the money in? Don't tell me the name of the firm yet, but what was the stock?
Multiples. Oh, my God. The risky stock spread was just incredible. And when I talked with the person and I said, hey, listen, now that I'm taking over for this, I don't know if that was on your side or mine.
Keep going.
Wow.
I think it was ours. I think it's somebody at Como did that. Yeah, they did that before.
Yeah.
Go ahead, Alan.
Alan,
you're all right.
This individual, as I told him, my risk tolerance is absolute safety for my mom, not this risky investments you have. He's supposed to be working for me, right? He's supposed to be working for us.
Yeah.
He then started explaining to me how his 90-year-old mother is in all this risky stock, and so that was a much smarter move. And then I start telling him, no, you sell it now. Let's go liquidate. He says he did it. He lied. A week and a half later, I find it still invested, and he tells me, oh, something must have happened on the Internet. I'm telling you the truth. This is a real story.
Come on.
He's so full of it.
What's the firm?
Angry. Oh, I will tell you, Merrill Lynch.
Go ahead. We don't care. Welcome to America.
Yeah, please.
I was so angry. Merrill Lynch, yeah. So their money right now is sitting in CDs. Okay, so it's not making any money, but it is safe. And so I just she has no prescription drug coverage. They were idiots, and they did not sign up for it when they turned 65, and so the penalty is too high. So all prescriptions are paid completely out of pocket. Oh, isn't that the most horrible thing?
That'll kill you.
So I know, right? Even the richest person. So I'm trying to protect funds, trying to be sure that I take care of her. So I know that there is a better way to invest this money than CDs, but that's the only place I stopped at was First Protect.
No. You just don't. You reacted. You reacted, and you reacted reasonably.
Correctly.
You went from craziness to sanity.
Yeah.
Now, let me before you get to fixing grandma, or your mom, your mom, my grandmother. No, because I'm so young. Before you get to fixing,
he just took the egg from his own mother. I think that's horrible.
Egg.
I feel bad. That's
as long as it wasn't the chocolate one, because Tom really wants that. What you really, really, really ought to consider doing is filing a complaint with FINRA, with the Financial Industry Regulatory Authority. You can go to their website, to FINRA, I think it's FINRA.gov or FINRA.org.
FINRA.org.
And file a complaint.
And it would take you as much time as you just did around just describing the situation. It doesn't have to be anything more than that. But, I mean, that's a ridiculous. I know, Merrill Lynch has trouble paying their internet bill.
But this guy, this advisor, and I really do use that term loosely, needs to be put out of his client's misery. And then let's take a break because we have to. Not because we want to, but we must. And then we'll come back and talk about what you might do going forward.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
Wow. We are on the horns of a complex dilemma here on Talking Real Money. We've got Alan on the phone. Alan's mom was put into some crazy, risky stuff over it at No Bull Merrill Lynch, which is part of Bank of America, Tom, one of your favorite companies.
Yeah, I'm really loving Bank of America because they do a great job of taking the money out of your account, putting it into escrow, and then not paying the property taxes. Now, wonderful people over there.
Alan, before we get to the money thing, you said something before the break that got me thinking. That your mom did not sign up for Medicare Part D, right?
That is correct, yeah.
The prescription coverage. Well, I'm at Medicare's site right now because I was trying to remember what the penalty was. And I see,
I'm sorry.
It's every month it's 1% of the national base, which is $33.
Multiply that from 65 to 87. It'll just make you cry.
Really?
So 22 years.
Yes.
Base number full
of the
uncovered
month.
So what do you estimate that to be?
Oh,
How much?
You're right, because it's for every bloody month.
Every month.
Yeah,
I've
so
already contacted
20
them.
years
The
times 12 months, it's hundreds.
240, yeah. I mean, yeah, okay.
That's the penalty.
That is enough to make you cry.
That's horrible.
What is your mom's typical cost of living? Let's start with that.
Cost of living, let's see. The spending, if you took a look at the entire budget, the spending is $9,000 a month. The cost of living
that includes
is, I'm sorry.
But her total budget, she spends about $9,000
everything.
All in.
Total budget,
okay.
yeah, everything.
And her sources of income cover how much of that?
$7,300.
So she has to make up a deficit of $1,700 a month.
$20,000 a year.
Yeah, $2,000 every month is what I pull.
How much money is in the CDs?
This is a nice one. So for at least I think it is, being us poor people, is just about $500K.
Okay. And how much are her other assets worth, from which she can derive?
No other assets. No other assets.
That's it. This is the whole thing.
That's it. Yeah, to me that's a lot. $5.
Well, it is a lot, and it's money to take totally seriously.
Yeah.
No, for me that's a lot. Tom and we're not rich people. We're not Dave Ramsey.
Thank you.
Yeah, no, we're just regular old working schlumps who, finally in their old age are making a decent living. But
Okay, so let's go back. Let's go back though. Let's
so
go
that
back.
she
Now,
needs a 4% return on that $500,000.
That's it. I just was right there. She needs a 4% withdrawal rate at 87. I mean, you could take more, obviously, because of her age. No offense. I mean, let's give her 13 years just for the sake of argument. Say she gets to 100, which would be wonderful. Here's what I would do. I mean, again, I don't know.
We may have a difference
tolerance.
on this one, Alan.
We may, because we talked about it off the air. I would just take it, and first of all, I'd probably take 2 years of the money she needs and keep that in the bank, or something like that. That would be 2 years.
Good. We're together on that one.
Thank you. There you go. And then I would take the rest, and I would just put it in the Vanguard Balanced Index Fund, which costs almost nothing. 60% of the money is exposed to globally oriented stock pool. The other 40's in bonds. You're hoping to make actually more than you're withdrawing. There's some volatility. Probably in the worst of times, it probably loses 25% of its value, but that's okay. Remember, you already have the 2 years set aside to pay every bill for the next 2 years, and now you're getting some growth. So it's a balanced portfolio plus cash. Go ahead, Don. You can argue with me on this one.
Yeah, I'd modify it just a little, because I still think that the balanced portfolio is a bit too aggressive, too volatile, maybe a little scary. You may look at it one day and see it's down.
Last spring.
Yeah. Down 20%. You go, oh, gosh, this was a huge mistake. The reason you want to reduce risk in a portfolio is not because we think that the entire stock market can ever go down and stay down. I don't believe it can. But it's because of human nature and the way we react to things. What I would probably do is consider something just slightly less aggressive, really well diversified, maybe better diversified, and that's the Vanguard Target 2015 or Target 2020 funds.
So is that 50-50?
No, the Target 2020
40?
is about 55-35. 55-45. But the 2015 is going to be about 40-60. Oh, I'm sorry. No.
Oh, by the way,
it's 55. It's 55 bonds, Tom, and 45 stocks.
Okay. Here's an idea. Then we can negotiate.
No.
You could put half in the 2015 and half in the 2020.
You're making it too complicated.
I know. I'm just teasing you. So, but something moderate. It's diversified. It's not wacky. You're not trying to pick the next. I can't come up with anything other than GameStop or AMC or Nifty or whatever it is.
Nothing. And I don't know. Were you paying Merrill on an annual basis or a quarterly basis for their advice?
I never got into seeing where they got their payment from. I
because
did not
my
take
understanding
a look at that.
My understanding is that the new Merrill Lynch is going all fee based. They're eliminating the commission incentive, but Merrill's fees, the last time I looked, and I haven't looked in a while, they're about 2% per year.
Which is absolutely crazy. And it's absolutely crazy that a fiduciary could tell you the internet was down, we didn't make a trade.
I got to tell you,
that's a new one. I haven't heard that.
If this guy is a registered investment advisor or an advisor representative, and if he's a CFP on top of that or something, you could get him kicked out of all kinds of stuff. He sounds terrible. But I wanted to contrast the fee structure. Whereas you probably paid a commission for those securities and a fee to Merrill of about 2% per year, the Vanguard 2020 fund, the target date fund, has fees of 0.13% per year.
Oh, wonderful. Okay, yeah, gotcha.
You see the difference?
Can I tell you something about Merrill real fast?
online.
Yeah. We love a good story.
When you sign up for Merrill, what I saw on the page was this is not FDIC insured, and the bank does not insure your money either. It says it right there in bold print. So all that money was sitting there completely at risk.
Of course, that's every stockbroker in America now has to say that, particularly if they do business or are associated with a bank. They have to say not FDIC insured. Well, I got to tell you, if you called us in advance, we would have steered you way clear of that. And that's why we encourage people to please call us prior to doing something, please.
Alan, thank you for your call. Good luck with the eggs. Don't elbow your mother out of the way at 87. So here's what we've heard this hour. It's fascinating. Remember, we had the advisor who came into the lunchroom to talk to teachers and sell them into annuities. We have this wonderful advisor who tells the client that the internet is down and they can't trade out of the risky stocks.
Oh, wait, you missed the best part that he put her in aggressive investments to begin with.
I agree. That's crazy. But that still doesn't match the advisor that we read about today that has 62 disclosures.
Explain what a disclosure is.
You go ahead.
It's a negative complaint against the advisor. Like this broker is going to have when Alan files a complaint, he will have a disclosure on his broker check.
This guy had been bounced out of 5 firms and is now, finally, after all this time, guess what he's going to do? He's going to go to federal prison because he was doing, it's more than a disclosure. He was doing all kinds of bad things. But this is why it's important. Only have a 100% fiduciary.
Yeah, good luck. They lie. They lie about that.
100% all the time.
I know, but they still lie. This industry.
So,
you know, this is why Tom and I will never, ever, ever be out of work doing this show, because this industry is so ridiculous, horribly deplorable in so many ways. And I still believe it's the majority. I believe it's the majority. 855-935-TALK. That's our number. Give us a call 24/7. Call anytime.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Scroll to the bottom of the page.
I love the side notes. Somebody just texted me and said, "You're not worth as much as Dave Ramsey. Dave's only worth $200 million. What's wrong with you guys?"
Yeah,
we're working.
We are deadbeats. No, we're not working on it. We're not going to be anywhere near that.
Come on,
you got to live for another 40 or 50 years, and
a shot at that.
And like Dave, pitch anything for a buck.
But you want honest help from a fiduciary advisor. And he's going to look at your situation and tell you, here's the deal. Yeah, you go to Vestory.com, as Don said, scroll to the bottom of the page.
It says schedule a meeting.
Schedule a meeting. You're going to get honest help. We'll really look at your situation. There's no obligation. There's no sales pitch.
Ever.
And don't believe me, we've done this for a lot of people that have said, hey, that's great. I really learned a little something. God bless. I don't need you. Or I could use further help. It's okay.
Let me explain why this works, because when you help people for free, they refer people. Go to Vestory.com, Vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.